When I ask you the following 3 questions, it should help you decide what type of apartment investment strategy you want to take. Are you a risk taker? Do you like to play it close to the belt? Or finally, do you consider yourself somewhere in between? If you answered risk taker, you're going to be more interested in what's called a distressed heavy lift asset. If you like to play it close to the belt, then you're going to go for what is called a yield play or a stabilized asset. And for you folks who are sort of a combination of the two, value add is for you. So let's dive into each one. Distressed heavy lift assets. These usually have a very low vacancy, and it could mean that you're getting and completely redoing a property. Oftentimes you will go into a more fringy area, and not only are you renovating, but you are rebranding its suffering image. This is called a reposition. These are opportunistic, and since they come with more risk, they should provide you higher returns. The team must have an experienced contractor, a battle-tested management, and definitely savvy marketing to clean up their image. Yield plays are fully stabilized and generally in better markets. They are fully renovated B+ or A properties that are basically turnkey and already providing consistent cash flow. They're going to have very low vacancy, and these are going to be newer builds, or they're going to be properties that have already gone through the value add. In this case, someone else has done the work and they've already repositioned it. It comes with the least amount of risk, but the least amount of return as well. It would be like buying a house that is already flipped, so you're not gaining any equity going in. The term in residential is a turnkey rental. Other than cash flow, the other ways you can earn on this type of investment: principal pay down by your tenants, tax benefits, and if you're lucky, some market appreciation. Now finally, if you answered that you are a combination of the two, then value add is your best strategy. Value add is where you have a performing property where you come in and you increase the net operating income, the NOI. And you can do this through rent increases or through operational efficiencies. You have a little bit more room to increase the income of the property, therefore you increase the value. So that's the value add. Value add can be a Class A, B, C, or D. It all depends on the opportunity that's within the income increase. But generally it's going to be your Class B or C. So we're talking buildings built in the 70s, 80s, and 90s. Since it is what we considered a performing asset, it will normally be around 90% occupied. So this is all important stuff because this all spills into what your renovation budget will be and what sort of tenant you will have, and whether they are working class or working professionals. It will have an effect on what kind of debt you will seek. If you're doing a heavy lift, short-term bridge debt may be your only option. If you are taking over a stabilized yield asset, then you'll probably be seeking agency debt. For value add, it just sort of depends. If it is slightly underperforming and occupancy is below 90%, you probably start with bridge debt and then refinance into long-term agency debt once you've completed the value add. I hope that helps. If you enjoyed this video, hit the like button below, share it with your friends, and definitely be sure to subscribe. I'm Rick with Fortress Federation Investments. See you next time.